Good morning. Thank you all for attending what is our first online annual client event. It's a real shame that we can't get together in person this year. As many of you will know, at Three Counties, we like to get everyone together once a year. In recent years, it's somewhere lovely like Beamish Hall, and have a catch up over some lunch whilst we listen to a couple of speakers talking about what's been happening in the world of financial planning and investments. Not only is it our chance for us to see you, but also it's a chance for many of you to meet up with each other. And I think it goes without saying, this year, most best laid plans have gone awry. Holidays have been cancelled, weddings cancelled, and I think it's safe to say that 2020 has been a bit of a flop for a lot of us. But at Three Counties, we're trying to make the most of the situation, both from a financial markets perspective, but also from a business perspective. We're striving to think outside the box when it comes to navigating this unusual year, and that's why rather than go a year without getting everyone together, we thought we'd move our client day online. This has also opened up the opportunity to invite new friends to come and join us, to have a listen and find out more about Three Counties. So for those of you who haven't attended any of our previous client events, a very warm welcome to you. For those of you who don't know me, I'm Corryn, one of the directors at Three Counties, and I'll be playing host for you this morning. I was really looking forward to hosting our client event this year. However, I didn't quite imagine that it would be from the comfort of my own home, but here we all are. So a couple of points to run through before we get started. Firstly, and most importantly, catering. It's not quite the usual for lunch, but for those of you who registered by the end of last week, hopefully you will all have received your tea and biscuits gifts in the post. I know we're at the mercy of Royal Mail coverage, which is getting a little bit patchy again, but hopefully everyone's has arrived in time. For those of you who are new to online meetings, everyone is in listen-only mode, and this means that you can't be heard or seen by anyone else. If you want to make a comment or ask a question, there's a chat box in the bottom corner of the screen and you can type into there and I'll pick up any messages as we go. In terms of the running order for this morning, first up we have Andrew Alexander, Director and Head of Investments at Three Counties. Most of you will know Andrew and have heard him speak many times before about the markets or our investment portfolios, and Andrew's going to give you a fresh update this morning. Next up, we have our lovely friends from Swinburne Madison Law Firm in Durham. Anna Stevenson and Nadine Walton will be talking about some of the new challenges associated with updating your legal affairs in the current climate. In addition, they'll provide an insight into some of the more recent developments in the world of estate planning, in case you missed them. Following Anna and Nadine, we have Julian Cook, Portfolio Specialist at T Rowe Price, talking about the US equity market and the upcoming US election. And finally, we have Colin Frame, Managing Partner of Greaves West and Ayre. Colin is also known as the Boss, and he will be joining us to talk about life since Three Counties Limited joined the Greaves West and Ayre family. So, without further ado, I'll hand over to Andrew.
Hello everyone, thanks for attending today. It would, as Corryn said, have been lovely to meet you all once again face to face, but the pandemic has dictated that we can't do that. So hopefully we'll be able to give you a bit of interesting information today. What I'm going to cover off today is the year that we've had, and it's been a very interesting year. Absolutely, in both investments and out with the investment market. But in the realm of investment, has been absolutely fascinating. And the title of today's presentation is "The Winner Takes It All." It's not because of ABBA, it's because of how the market's performed. So looking at today's agenda, first of all, we're going to kick off with the performance year to date, looking at how the markets have performed pre-pandemic, during the significant fall of February and March, and then the recovery, sometimes large, sometimes small, since that period of time. Then I'm going to have a look at the individual winners and losers and give some kind of rationale as to why that's been the case. And then finally, moving forward, what we believe is the likely path, how we're preparing our clients' portfolios for this, and the thoughts and the considerations that everyone should have moving forward into the back end of this year and into 2021 and beyond. So first of all, performance year to date. This is a chart from the 1st of January to yesterday, I think it was. And essentially what I've done, I've put together a whole series of indices, whole series of markets, and to really emphasize the disparate nature of performance. And I've highlighted 4 individual indices and essentially 2 individual countries. At the top, and the thick pink line, is the NASDAQ. The NASDAQ's at the top. I think that's teal. We'll call it teal anyway. Thick teal line, that's the NASDAQ indices. And then the pink line is the S&P 500. As you can see, the markets, the US markets, have recovered phenomenally well, performed phenomenally well, outperforming all other indices. And obviously, Julian's going to touch into much greater detail with regards to that later on. The other side of the coin are the 2 indices at the bottom. And unfortunately, that's the UK. The UK FTSE 100, which is the blue line, and the green line, which is the FTSE 250, have not recovered to the extent of other markets. We'll touch on that a little bit later. Now, on the next slide is exactly the same chart. However, what I'm emphasizing on this one is the bond markets. So bonds at the beginning of the year, when equities fell, performed in exactly the way that we believe. One of the reasons why we held or continue to hold bonds, but held bonds at that time, the type of bonds that we held, was that they perform in a way negatively correlating in reverse to equities, and they provided a really, really good buffer. So that's fantastic. However, since then, as equities have recovered, they've kind of plateaued. In fact, some of them have tailed off as well. So that needs to be a consideration moving forward. It is something that we're thinking about. So equities, very disparate. Bonds have worked in exactly the way we intended. So winners and losers. The first winner, the main winner, technology. This chart shows the blue line, thick blue line, which is the MSCI World. And it's an aggregate of all the stocks in the world averaged out. And as you can see, year to date, it's in positive territory. That's good. It's up 1.64, despite that 35% plus drawdown between the 23rd of February and the 23rd of March. It's recovered, and we're in a positive territory. However, you look at how technology has performed. Technology that has been the real winner out of the pandemic. Technology like this, what we're using today. Amazon, I'm sure you've all had deliveries from Amazon. In fact, the Amazon man knows me by my name now, which is a bit ridiculous, to be perfectly honest. But technology has been the real winner out of the pandemic. And if you look at some of those returns, we're looking between 30 and 45% year to date in terms of tech, which frankly is absolutely phenomenal. A lot of these returns, a lot of these performances have been brought forward. The expectation was that they would develop over the next few years, but the catalyst of the pandemic has really exacerbated the development in technology. The next winner has been clean energy. If you can remember, pre-pandemic, Extinction Rebellion, bringing boats into the middle of Westminster to hold up the streets. Now, whatever you feel about that, the nature of that game, the winner from the pandemic has been clean energy. So not your traditional oil and gas and fossil fuel energy, but clean energy in its myriad forms. If you look at there, I'm highlighting the iShares Global Clean Energy ETF. So it's a vehicle, it's a fund that tracks an index that only holds clean energy stocks, and that year to date is up over 80%. So you're looking at some phenomenal returns even during this pandemic. However, it's not all grand. There have been significant losers. And the first one is one that I've been talking about for quite a long time, certainly over the last few months at various different webinars that I've hosted, and if you've attended, you'll know about this, is what we call value stocks. Value is stocks that pay a dividend, that are maybe underpriced by the market, and fund managers will buy because they believe there is value in buying them cheap. The market's got it wrong, and when it recovers, they will sell and make a profit. However, these stocks are cheap for a reason. It's because no one wants them. Banks, airlines, cruise lines, hospitality, traditional industrial stocks. All of these stocks have fell out of favour, and instead people have been piling into what we call growth stocks, so the innovation stocks, the tech-driven stocks. The dark blue line is the MSCI World, again, same index, but the orange line is the MSCI Growth, so just the growth stocks in that index, and the green line is the MSCI Value, so just the value stocks in that index. And if you look at that, you're talking nearly a 40% differential in performance over 2020 alone. That is phenomenal, and that is simply compounding upon previous years, because this is a theme that's been happening over and over again. And within our portfolios, Julian is going to be talking about his fund, which is the US Growth Fund. It's in our portfolios. We've been actually placing growth stocks, growth funds with our portfolios for this exact reason. The second loser, and probably the reason the value stock is the reason why, is UK equities. UK equities, from large cap to mid cap to small cap, all represented upon this chart, have suffered. And it's because the UK equity indices in the main hold value stocks, and value has been significantly underperformed. Now, we've got headwinds. Currency's been a headwind, Brexit's been a headwind. Some may say the government's handling of the pandemic has been a bit of a headwind, but essentially the US equity market has underperformed because of the stocks that they hold. If you do a comparison with the 100 largest stocks within the UK and the 100 largest stocks within the US, the difference is absolutely astronomical in terms of performance 2020. And so that we may be starting to see a bit of a change where these companies unfortunately lose value, fall out of indices, and smaller companies that are benefiting will rise up through the ranks and become the next blue chip companies of the future. Change always happens because of a catalyst, and maybe the pandemic is going to be the catalyst, but again, that's something that we're thinking about. And then finally, tying on with the previous slides about the winners, clean energy, a massive winner. Traditional energies have been a massive loser. So you're talking between a 25% to a 45% fall in value for these traditional energy stocks. So there have been winners, there have been absolutely massive losers, and it's really important to be on the right side of the fence there. However, moving forward, what do we think is going to happen? Well, I haven't got a crystal ball. I haven't got the ability to tell you what tomorrow's night's lottery winners are. I don't know. Because the pandemic has no sign of abating, I think it's pretty confident in saying that the winners currently are going to continue to be the winners up until there's a change, and again, until there's a catalyst for change, and that may well be a vaccine. But it's not just predicated upon a vaccine, it's predicated upon a vaccine that is tested, that is accepted by the population, that is creating numbers to be able to distribute it throughout the globe, essentially, so that we can actually combat, or there's a complete change in mindset and the social understanding about the pandemic actually changes. So what do we think is going to actually happen? Well, because of this continued pandemic and because of continued lockdowns, we believe there will be a continued bifurcation. This is a term that's being used within the investment community during the pandemic. That is the big difference between the two sides of the coin. So what are we doing with regards to moving forward? Well, we're increasing our US allocation, again, increasing it to T Rowe Price, which Julian's going to be touching on in a few moments' time. And we're doing that because we firmly believe that the US, the broad US market, has much greater opportunities for excess returns than they do within the UK and Europe. And when we say change, we don't mean huge wholesale change, we mean a few percent here or there. But we are overweighting our US equity allocation. We're also increasing our growth stock allocation, specifically within the UK, which is very important. The UK, by its very nature, is value oriented. We feel we need to remove ourselves from that as much as we can within the risk tolerances that we manage all the portfolios within, and hence we're increasing growth allocation within the portfolios. And then finally, and probably the most important thing, to be perfectly honest, is our focus upon inflation. And we're doing that through an allocation of infrastructure and gold. You may well have heard or listened to Boris with his building Britain better or something like that. The good politicians love alliteration. They absolutely love it. The focus upon the development of infrastructure for the benefit of the economy as a way to generate revenue for the country and to get us out of the pandemic or the economic hole that the pandemic has resulted in. We are investing directly into infrastructure by an infrastructure fund, which has a natural inflation hedge because the tariffs that the underlying holdings generate are index linked. So that's a very good diversifier. And then gold is a fantastic store of value. Despite fluctuating currency markets, gold tends to hold its value in as opposed to baskets of currency. And also when markets get a bit choppy, gold tends to do very well as well. So inflation is something that is key, and I just want to talk through this slide as to why. Inflation, we believe inflation is going to rise simply because of the fact that the amount of government spending to combat the pandemic we believe, should be inflationary and coming from a very, very low base. But a lot of investors think, that doesn't bother. Yeah, you talk about it, doesn't really matter. Well, it does. And what I want to give an example of is if I gave you 1% fixed per year on a savings account, and we used a value of £100,000 at 0% inflation after 10 years, and this is on the table on the right hand side, your statement at the bank would read £110,462.19. You think, great, I've made £10,000. If there was zero inflation, that's exactly what you've made. But if there was 1% inflation over that 10 years averaged out, you would look at £110,000, but it would only be worth £100,000. 2% inflation, you've actually lost nearly £10,000 in value, spending power. 3% inflation, you've lost nearly 20,000, and 4% inflation, you've lost nearly £30,000 worth of value. And that's the effect of inflation. Now, inflation, we believe it's going to happen. The banks, the central banks, have been quite open with the fact that they will have no problem with letting inflation run as a result of the pandemic in order to increase fiscal strength globally. So that's what we believe. It's a really important factor, and we're building it into the portfolios. So to conclude, 2020 has been the most bifurcated year in history. I love that word. I've never heard of it before, but please use it, or you will. See how you can actually fit it into your day-to-day conversations. It's been the most bifurcated year in history. There's been a huge differential between the winners and the losers, and while the pandemic continues, we believe that this differential will continue. Finally, inflation will become the most dominant theme across our portfolios and should be across everyone's portfolios moving forward. And that, ladies and gentlemen, is me. I'm done. What I'd like to do is hand over to Anna and Nadine from Swinburne Madison.
Thank you, Andrew, for the introduction, and thank you very much for inviting us for your Client Day. I am as well very sorry that we can't be there in person, meeting face to face and handshaking, but hopefully next year we'll be there. It's a real pleasure to have the opportunity to speak with you all today. Our firm have enjoyed working with 3 counties over the last few years, and we've enjoyed staying in regular contact over the last 6 months, despite the hurdles that we've had in our way. And the relationship hasn't been phased, and it's continued to grow, which is lovely. Dean and myself are managing associates in the firm of Swinburne Madison. We're proud to be part of a growing firm which is established in Durham, but our services do stretch further afield. Recently, that's been facilitated by the benefits of video calls, which I'm going to touch upon shortly. We work in the private client team. We offer services ranging from the drafting, preparation of wills through to estate planning, the preparation, registration of lasting powers of attorney, and advising in relation to court protection matters and administering trusts and estates. I'm going to touch upon today a very recent development in the law which provides for the execution of wills via video conferencing. It's quite a hot topic at the moment, so it's very new to us all, so we're just all trying to understand the implications of it and advise our clients how to proceed. Proceed with caution is really the key word here. So as you'll see from this slide, it's recently been brought into effect, and it covers wills from executed in January of this year through to 2022. It allows for a testator, who's a person that's making the will, to sign his or her will in the presence of 2 independent witnesses, who may be present via video link as opposed to sitting across a desk in the same room. So using the likes of FaceTime, WhatsApp video calls, Team calls, Zoom calls, whatever, It's a video link that's crucial here. The will is then delivered to those witnesses, whether it's by post or hand delivered, who must sign in their capacity as witnesses, but again via video link with a testator who must be present at the other end of the video call to see the witnesses printing their full name, address, occupation. So it's an incredibly useful development in the circumstances, ensuring that wills can be made, they can be updated in the safest way possible. It really links in with how we're working at the moment. So the key point to emphasise here is that will drafting doesn't need to be put on hold, and affairs can be managed even though we're all living with very tough restrictions. The real guidance for you today is that you must always proceed with caution and always seek professional advice. It's essential that any document, any legal document, is executed properly. The validity of a will is key. There is scope for errors, and also it's really important that the necessary steps are followed. So we're here to help, we're here to advise and provide guidance wherever it's necessary. Through video calls, we're able to stay in regular contact. We are also holding face-to-face meetings at our office whenever appropriate. And as a team, we do pride ourselves on a really personal approach, strong client contact. We really do enjoy establishing long-term relationships with our clients, but also professionals such as 3 counties, Greaves West and Ayre, to ensure that we can work collaboratively and provide a really comprehensive service to our client. I'm going to hand you over to my colleague Nadine.
Hi, morning everyone. Thanks Anna, and thank you to 3 counties for having us. It's lovely to be able to speak to you remotely today. I'm going to talk you through the nuts and bolts of the residence nil rate band, as it says on the slide. Anna and I are both trying to touch on what's been referred to as hot topics today, and this is still something that we consider to be a hot topic because even though it was introduced in 2017, the rules around it are so complicated, as you'll probably see from what I'm about to say, that it's often misunderstood or overlooked or even sometimes disregarded by clients. So it's just to give you more of an overview on the rules and what you should really be looking out for in terms of reviewing your planning, so you know what's what. So most clients are familiar with the ordinary nil rate band, which is obviously the amount, the value that instead of facing inheritance tax at 40% is chargeable to inheritance tax instead at 0%. And that it currently sits at £325,000, as it has done for many years now. It's transferable between spouses. So in a typical scenario where one spouse leaves their entire estate to the other on the first death, on the second death, you would then have, or the executors of the second spouse would be able to claim both nil rate bands. So they would have a maximum of £650,000 of ordinary nil rate band allowance to claim in that second death scenario, and that's because the transfer to from the first spouse's estate to the second spouse on the first death is covered entirely by what we call the spouse exemption from inheritance tax. So it's treated by the revenue essentially as a non-event, that first death in that scenario, and the first spouse is treated not to have used their nil rate band. So that's why on the second death you can get both and double up your ordinary allowance. Now, fewer individuals are familiar with the residence nil rate band because, as I said, that only came in from April 2017. So it's only been with us for comparatively a short time, and it's actually an additional allowance that can increase the value of your estate that suffers tax at 0% as opposed to 40%. And it's currently worth a maximum in this tax year, 2020-21. It's currently worth a maximum of £175,000 per individual. And like the ordinary nil rate band, as I've explained, it is also transferable between spouses. So again, in that scenario where one spouse leaves everything to the other, on the second death, you would potentially have a maximum residential nil rate band of £350,000. That's your 175 times 2 that your executors could claim on that death. So you can see that's where your £1 million figure comes from. It's not applicable to every estate, but in a second death scenario between spouses, you could potentially have £650,000 of ordinary allowance and £350,000 of residence nil rate band. So that equates in total to £1 million. However, the residence nil rate band is not nearly as straightforward and indiscriminate as the ordinary nil rate band, so it does not apply to every estate. There are certain conditions that must be met before the allowance can be secured. Essentially, in a nutshell, and it's very difficult to put this in a nutshell, the residence nil rate band will apply where on the death of an individual with an estate worth less than £2 million, they leave an interest in a residence or equivalent funds to what they've held at formerly in a residence to lineal descendants, and those lineal descendants, the residential interest is closely inherited by those lineal descendants. So obviously within that simple explanation, I have touched upon various important subconditions there, which we need to expand upon so that you understand all of the niceties. So the first one really that's key is there must be an interest in a residence in the estate. So you have to, what that translates to is at some point prior to your death, you have to have held a stake in a property, even though, and I'm not going to go into this today, but even though it's important to know, you may dispose of that interest prior to your death, you have to at some point have held a property interest. And it has to be an interest in a property that you've occupied as your home, importantly. It can't be a pure buy-to-let property. You have to have occupied it at some point as a residence. That interest, or the equivalent value, must pass to lineal descendants or into certain trusts for the benefit of lineal descendants. So fortunately, the definition of lineal descendants is quite broad. So it doesn't just implicate biological children, it also includes stepchildren, adopted children, foster children, and the next generations down. So if you'd prefer to leave your estate to grandchildren, for instance, that they can benefit from the residence nil rate band, as can the next generation thereafter and your remoter issue. But you can't pass the interest across to siblings, nieces, nephews, cousins. It has to go down the lineal line. And this idea of close inheritance by those lineal descendants is important as well. And essentially that means they must take some form of immediate right to the property. So there has to be basically no strings attached to the gift to them. So consider here, if you have left the entire estate into a discretionary trust, which some people choose to do for a number of reasons, that gives your executors and trustees, by definition, discretion as to how to confer benefit on your chosen beneficiaries, when and in what amounts, etc. That's not necessarily conferring on your beneficiaries an immediate interest in the subject matter of your estate, including your property. So that is not of its own accord going to meet the test to capture this allowance unless some action is taken following the death. So don't panic, there still can be action taken and the property can be appointed out of that trust within 2 years of your death. But it's probably worth you reviewing your planning and making sure you understand what has to happen for that relief to be, for that allowance to be captured, is the key point here. Similarly, if you've got, for instance, wills that leave estate to grandchildren and you've set an age contingency as to when you'd like them to inherit, it's say 25 or 30. If you die at a time when they're under that age, you can see they're not going to inherit outright. They've got to wait until they hit that age. So that, by definition, means they are not getting an immediate interest in the property, and you're not going to capture the allowance. So we would potentially look at that planning as well, depending on your thinking and how you weigh up, the benefit of waiting until they're a certain age to get the property versus potentially losing the allowance. The last point really is the £2 million threshold, which I've alluded to. So this relief, I keep calling it a relief, it's an allowance, only applies to in full to estates beneath that £2 million threshold. So if you've got an estate which in total tips that mark, the allowance is tapered away. So what happens is that for every £2 an estate exceeds that £2 million mark, £1 is lost. So it's quite a complicated calculation, but you'll see that if your home residence nil rate band is worth 350,000, once an estate gets to the mark of 2.7 million, that relief's lost altogether. So what we can look at with clients, if they are above that mark and they're thinking, oh, I could really do with that extra allowance, is reducing the value of their estate for inheritance tax purposes via lifetime gifting, whether that's into trust for the benefit of the next generation, or whether that's via, you know, outright gifts, depending on their thinking on the issue. And the real advantage of that is, even though any lifetime gifts that you make are still subject to a 7-year clock for calculation of it, for inheritance tax purposes, the instant that you get assets out of your estate is the instant that counts for the purpose of claiming the residence nil rate band. So as soon as you make a gift and bring your estate underneath the £2 million threshold, you will attract the residence nil rate band if your death happened the next day or the next week or the next year, even though you would that gift would be brought back into your account for the purpose of calculating the tax. Within that calculation, you'd benefit from the extra allowance. So that's really attractive to a lot of people with larger estates as well. So I guess to summarise, the best advice I can give you off the back of today is, firstly, not to panic. There's probably a lot there that I've said that you're thinking, oh, that sounds really confusing, and I'm not sure, you know, whether my estate's going to qualify, etc. Don't panic. Just use the opportunity today really to take away a few key points, not everything, and review your planning with your advisors, and ensure that everything's in place really to allow you to capture the allowance with them. And if you want to do that via us, obviously we'd be really happy to hear from you. So yeah, we're really happy to have a no obligation call with clients and just discuss matters with them that they're concerned about. So do take something away from today and review your planning for that relief if you can. And that's it from me.
Thank you very much, Anna and Nadine. Estate planning is clearly such a complex area, and you did explain that really thoroughly and really clearly, so thank you. And as Nadine just mentioned, if anyone wants to be put in contact with Swinburne Madison, just give us a shout and let us know, and we'll be able to do that for you. Now I'll hand over to Julian Cook of T Rowe Price.
Hi, Corryn, and thanks very much to Three Counties for having me on your call today. I didn't get the biscuits, but maybe I'll get them next year. So yeah, many thanks. Just a quick question, a quick comment about T Rowe Price for a second, for those that are not familiar with us. We're a very large US equity fund manager. We run about $1.2 trillion of client assets, and so we are a very, very large asset manager. In terms of, I guess, our exposure to US equities, we run about $800 billion in US equities. So again, a very sizable part of our client asset base is in the US equities. So I know from Andrew's introduction, he kind of mentioned that you know, US large cap growth, which is a strategy that I'm the advocate for here in Europe. You know, we've really been at the sort of the tip of the spear of what's happened in global markets this year. Everything we do at T Rowe Price is active management. So when you think about us and the portfolios you may be exposed to at T Rowe Price, think of us as having, you know, deep research capabilities in order to gain insights on companies that we then make, you know, significant investments into. So that's a quick comment about T Rowe Price. With regards to the year so far, it's actually been a pretty odd year. Again, as mentioned by Andrew, we've seen this tremendous performance of US growth stocks, measured by the Russell 1000 growth benchmark, up 27% year to date.
growth stocks have done phenomenally well. Value stocks are down about 9%. So even in the US market, there's been this huge differential of performance between the sort of the haves and the have-nots. Now, just thinking back, just for a second, back to March, we saw huge dislocations in the market back in March. And I guess now with the benefit of hindsight, we've gone back and looked at decisions that we made in that time period to sort of give us a scorecard as to whether, how well we think we did. I'm pleased to say that the stocks that we bought and the ones that we sold, the ones that we bought actually on average did pretty well, and the ones that we sold actually didn't do so well. So we think we did some very good decision making over that time period when we saw our turnover essentially double up to 60% to take advantage of those dislocations. Now, that's not to say we didn't make mistakes. We did. Probably the two biggest mistakes is really we underestimated the size and the duration of the recovery that we saw in the US. Had we known that, I guess with the benefit of hindsight, we'd have been more aggressive and we would have stayed buying new ideas through sort of maybe to the April-May timeframe as opposed to just into the March-April timeframe. And so I guess that has been our biggest learning. There's also been some tremendous performances by some companies. Again, you've seen some companies like Apple. I'm sure you've seen the iPhone 12 launch. Apple is a stock that's up 80% year to date. We are very much underweight Apple, and so that's, I guess, been a drag to us, and that's I guess another mistake we made. But we don't regard Apple as being a particularly growthy company, and maybe that sounds a little bit odd. But if you look back over the last 3 years, they really haven't delivered any kind of EBIT, earnings before interest and tax, any growth over that time period. So for us, as much as iPhone 12 may look like an attractive product, isn't really enough to re-energize the growth rate of that business, in our opinion. And the escalation in that price has really been driven by an inflation of valuation. Similarly, Tesla, which is a company you may have heard announced results yesterday. Tesla has been up at one point this year, up 500%. When we look at the valuation of that business, and we know this company really, really well, a year and a half ago, we were the second largest holder of that company behind Elon Musk. We don't own a single share today in this strategy. Why? Because we think the valuation here has actually become too high, almost like stratospheric. So we're not interested in owning companies that have sort of gone beyond where we think there's reasonable valuation. So think of this strategy as one which really tries to play for risk reward, and we're trying to make that judgment constantly, always trying to find I guess a new idea which has a better risk reward profile. I'll give you just two examples. We bought a company in that dislocation time back in March called Carvana. Carvana is a business where you can buy a used car online. Now, it's an attractive business because not only is it a very large total addressable market, like an $800 billion market in the US, but the online penetration is about 1%. So it looks really, really attractive from a constructive market perspective. We bought it in the dislocation that we saw in March, April at about $25 to $40. But it was at that time probably a top 5 risk reward idea for us in the strategy. Look at that stock today. In the meantime, it's gone up to $225. So a huge performance, and now is in our top 10 least attractive risk reward ideas in the strategy. So don't be too surprised if you see us pull some money off the table when we think the risk reward is no longer attractive. And then the other example I was going to give you is Cigna. Now, you may know health insurance. Cigna for us is a company which has delivered over the last 20 years 16% year in, year out earnings growth. That company has seen a decline in its relative valuation of about 35% this year, and that's absolutely a name that we want to be owning. So not the sort of sexy high-tech growth companies you might expect to hear about, but that is, I guess, how we think about risk reward. We really want to look for companies that can grow their earnings, but also look attractive on a valuation perspective. So our positioning right now is probably the most defensive we've ever been. We're a growth strategy, so we're more growthy than the benchmark. We're at about 15% earnings growth. Benchmark's about 12.5. But we are trying to take individual stock positions which reflect what we think looks like good risk reward opportunities. And then just the last two things I was going to mention, the two biggest unknowns out there right now, obviously one is US elections, and second is coronavirus. On US elections, how we're positioned, we're overweight in areas like health insurance, which if we do get a blue wave, like a Biden president and a Democrat Senate, a blue wave would actually be, we think, hurtful to our overweight positions in health insurance in the short term. But the market, we think, has misinterpreted what the medium-term outlook is for these kinds of companies. So we're very happy to be, I guess, hurt short term, but own it over the next 2, 3, 5 years, because we actually think they're very well positioned as businesses like Cigna to grow, and they're currently at very discounted valuations. Also, if you are to see a blue wave, you could see a hit to S&P earnings of about 7 to 8%. And that we think would be a possible detractor to people's enthusiasm about the market. And then the other point being really to expect high regulation in financials. Imagine Elizabeth Warren as Secretary of the Treasury, for example, and also regulation towards technology companies. So those would be a few things, a few areas to look out for if we do indeed get this blue wave. And then on COVID-19, it's our expectation that you will see I guess 75% probability of a vaccine by March 2021. I think, as Andrew kind of alluded to, that will take time. Firstly, there's an adoption question, like how many people at the moment, like there's as many people want to take the vaccine as don't want to take the vaccine, and there'll be probably a 6 to 9 month period to get those that want it get access to it. We actually think that the Sanofi product, which is kind of come at the later end of that timeline, is probably going to be the more effective one, but I guess we'll have to wait and see. But that is coming, but the rate of adoption is going to be key in terms of how effective that can be. And then conclusion for me, if I think about growth equity, we're right here at a point where we think that there's going to be still low growth in the economy. Low inflation is our view, and I appreciate Andrew's comments earlier. And low interest rates. And so for us, that combination of that kind of environment, you may get these little skirmishes towards value if you see a pickup in GDP, because some areas in value are extraordinarily cheap, but you need a sustainable catalyst to make them move. But in that sort of low interest rate, low growth, low inflation type environment, we think that is still a very conducive environment for secular growth rate companies in the US. So from our perspective, it's still a position where we are cautiously optimistic is probably the best way to describe it. We've come a long way. We're not ignorant to the fact that these stocks have moved a long way, but we're trying to make really good risk reward decisions on individual companies where we think we can do well for clients. So Corryn, with that, I'll hand it back to you.
Thank you very much, Julian. It's really interesting to hear your thoughts on the impact of the upcoming election on the market, so time will tell. Finally, we have Colin Frame, Managing Partner of Greaves West and Ayre.
Good morning, everyone. First of all, can I say that I hope you and all your loved ones are safe and well during this current health crisis. I think it's fair to say that none of us have experienced anything in this scale, and it's been a really difficult time for everyone. Secondly, I wanted to say a massive thank you to you, our clients and contacts, for your continued support to everyone involved with 3 counties. During this pandemic, there have been a lot of changes in the UK, but our main aim through this period, after making sure our team are safe, is that you, our clients, have been able to rely on us to be there when you needed us. Let's face it, if you can't reach out to your professional advisors during a global pandemic, and then when you really need them, then are you really with the right professional advisors? So we've worked very hard to keep things running so that you can stay in touch with us. Little could we at Greaves West and Ayre have expected that when we purchased 3 counties from Peter West and his family in July 2019, that we would so quickly face such a significant world event. I had the pleasure of meeting some of you last year before things went into lockdown, and I had hoped that this year's Client Day would have given me the chance to meet more of you. However, as Corryn had said, COVID has put paid to that idea for this year, but hopefully I'll be able to meet more of you at future events when we get through this current time. For those of you that I did meet last year, I hope that you have found that Greaves West and Ayre have lived up to the commitments that we made to you last summer. Namely, that we were committed to continuing to grow 3 counties, that the office at Burnmoor and the staff would be retained in the longer term, and that we would look to invest in the people and the business with the aim of building on the hard work of the previous owners to see 3 counties not only survive, but thrive. We believe that there is a real need for quality advice and quality service within the professional services industry. Greaves West and Ayre, as an accountancy firm, is over 100 years old and has grown by putting at its centre a determination of providing a high level of quality in the advice we offer, and to also deliver that in the best way that we can. When we came in contact with 3 counties, we found in their people that those beliefs are shared. And so I can honestly say that the last 15 months have been a real pleasure, as I've seen the team at 3 counties strive to make sure that you, our clients, got the care and attention you so richly deserve, and during a crisis so badly need. Behind the scenes, we've been working hard to invest further in our people, with exam passes and by successfully gaining the status of a chartered financial planning practice, which demonstrates our commitment to continue to try and maintain the high levels of advice and service that is needed in today's modern world. That investment continues into 3 counties as a business, and we support the team with the various initiatives that they have identified as being needed to continue to evolve the business to meet the demands that are placed upon them, and also upon you, our clients. I'd like to take this opportunity of repeating Greaves West and Ayre's commitments to you and to our employees from last year. Namely, we will continue to invest in our people and the premises to ensure that no matter what else comes our way, that 3 counties grows, thrives, and is around for many years to come, to ensure that we continue to service the people of the North East in the way that they deserve. I hope that you've enjoyed the rest of the speakers today, and that you enjoyed the remaining part of the webinar, and I hope that you're all able to join us again for next year's Client Day, in whichever form that might be. So thank you again for your time and for your support. Corryn, I'll hand back to you now.
Thank you very much, Colin, and here's to many prosperous years ahead for the 2 firms. And that concludes the presentations for this morning. So with those finished, I'm just going to have a look now to see if we've got any questions in the chat box, just while everyone else is popping back on the screen. Let's have a look. So the first one that's in sounds like one for Julian for me. What are the key drivers of growth in US stocks?
Yeah, thanks, Corryn. I think it's a really interesting question, and I think I can best answer it in kind of in a 2-pronged approach. Firstly, I guess it's the appreciation in valuations which have been pushing US stocks. So that is predominantly a result of interest rates. So there's a valuation argument to why multiples is as high as they are, and I think that's an interest rate question. So that's the first point of it. And then I think for us, more fundamentally, because I think we want to look more at fundamentals on businesses, it's like what actually drives free cash flow growth of a business. And I think disruption and innovation are probably the 2 most overused words in growth investing in the US. Unfortunately, they're both true. If you have large total addressable markets, like I guess the example I mentioned, Carvana, an $800 billion market which has less than 1% penetration from online, is a very large, fertile growth field for a business to exploit. So if that business can grow its free cash flow by taking a total addressable market, which is as huge as that, and grow into that, then that's going to result in tremendous free cash flow generation. So I guess that's one way to think about it. And also there are businesses out there who have shown a very good ability to durably grow their free cash flow year in, year out, north of 10, 12%. And that ability to basically, so things like sort of payment processing as an example. One of the companies we own is called Global Payment Networks. It provides sort of payment processing. So if you're a restaurant owner, you can have that company manage your receipts, your bills. But in addition, they'll say, okay, well, you transact with us, and tell you what, we'll give you free software to run your front of house, to run your booking system, to help you, also make you a bit more sticky as a customer. And so you're seeing businesses innovate and basically redefine their businesses to gain that kind of durable free cash flow growth. So I think it's really down to those kind of key factors. So firstly, valuation, and then secondly, the ability to generate free cash flow growth.
Thank you very much. We have one here which will certainly be best answered by Anna or Nadine. Our wills are older than 2017, but they don't use trusts. Do we need to change anything to get the residence nil rate bands?
Sorry, I'm waiting for myself to be unmuted there. Not necessarily is the short answer. So if you have, for instance, older wills that predate the change in the tax legislation and are just simple documents by which on the second death, for instance, you might say the entire estate passes to your children, I guess is the most common one, as between married parties with kids, then you wouldn't necessarily have to change anything to obtain the residence nil rate band. It's often the case that if your affairs are more straightforward like that and haven't involved you previously putting trusts into your wills, then you are going to attract the allowance easier than if you've put discretionary trusts in your wills, for instance. But the best advice I would just reiterate is probably to just get them checked by your own advisors, or come and see us to check them out anyway, because it's worth us just reviewing everything with you in the round. It's not just the drafting of the terms of your will that need to be looked at in isolation. We need to consider, are you over that £2 million threshold? Is there something in there that might, if you're in a second marriage situation and only one party's got children, for instance, then depending on the party that dies second, if they want to leave assets to non-lineal descendants, you might lose that residence nil rate band. So we need to look at everything in the round, really, to be able to give a categorical answer as to whether you're going to get the allowance or not. So it's best to just get things reviewed. You might find you need no changes whatsoever, but yeah, we'll discuss everything with you and give you a fully advised opinion after we've done so.
And I think the peace of mind of just knowing it's been checked and that everything's right and everything's as it should be is invaluable, isn't it? We do have another one that's come in. I'm presuming, Andrew, you're going to want this one. How might Brexit situation affect investments?
It's looking more likely that there would be no deal, and therefore the sterling has come off, and as a result, that's kind of given a little bit of underpin to large cap UK equities, because the majority of their earnings are earned overseas, and if sterling is cheaper, then the profitability rises. If you're solely invested in the UK, then it may affect you. However, I would suggest that no one listening to this call is solely invested within the UK, and therefore you need to look at how much UK allocation you actually have in your portfolio. So, for instance, our moderate portfolio has, let's say, 17% UK equities, and that's quite a lot because it's a home buy. We're UK investors. We invest in sterling, but it's just 17%. It's not a huge amount. So I'm not playing it with a straight. Well, I am playing it with a straight back completely. Don't worry about it. What'll be will be. You know, there's far too many other things that you need to think about. As Julian alluded to, the US presidential election will have much greater effect on your portfolio than anything else, because, you know, when America sneezes, the rest of the world catches cold.
Brilliant, thank you very much. So with one last check, I think that is it for questions. Everyone can relax, there are no more. And just one last part from me then. A little bit of news from 3 counties. So firstly, we are delighted to announce that Emma, our trainee paraplanner, has recently accepted a proposal of marriage from Connor, and they are now looking to set a date. So huge congratulations to them. And secondly, we are creating our own YouTube channel. That's what we're busy with at the moment, which is really exciting. And this is going to be the place to go for all of our video content, which will make life much easier for you to watch them. And you'll be able to see an ever expanding range of interesting information on there. So we'll keep you posted as to how to get the most out of that. So watch this space. So that brings our client event to a close. A little different than usual, but I hope you enjoyed it nonetheless. Thank you so much to our guests for speaking today, Corryn, Andrew, Anna and Nadine of Swinburne Madison, and Julian of T Rowe Price. So that just leaves me to say thank you to all of you for attending. Take care of yourselves, and I wish you all the very best. Goodbye.